A CFD, or contract for differences, is an agreement between an investor and CFD broker to trade on the difference in the value of a financial product between the time the contract opens and closes. Investors can trade in real market conditions without the need of owning the underlying asset. It is believed that CFD's history can be traced back to financial services firms in London in the early 1990s. CFDs were initially used to offset the risk of loss from stocks traded on the London Stock Exchange. The late 1990s saw the rise of online trading, and CFDs were introduced to retail traders by brokers as a new investing tool. In 2002, CFDs were introduced to the Australian market, and the CFD market in Australia grew quickly, with nearly 40,000 active CFD traders in Australia alone. In 2007, Australia became the first country to offer CFDs on an exchange. Today, CFDs are very popular in countries where they are available, and are offered in a very diverse range of financial assets. With a click or a tap, traders were able to trade financial instruments that they did not have access to before. CFDs allow traders to trade on markets that are heading downwards, in addition to those that are heading up, allowing them to deliver profit even when the market is in turmoil. CFDs are offered for instruments including Forex, stocks, indices, commodities and more. CFDs are levered, which means a relatively small amount of capital can deliver great potential returns. For example, a leverage ratio of 1 to 20 means you can open a trade valued at 20 times your capital. CFDs can be traded on a wide range of worldwide markets anywhere and anytime, without any limitations for short selling and day trading. CFD brokers offer many order types as traditional brokers, including stops, limits, and contingent orders.